My name's Nick Walton. I'm a portfolio manager with First National Wealth Management. Recent changes in the political landscape have led many investors to question how their portfolios should adjust. Today, we're here to talk about navigating market uncertainty and the importance of staying the course. There's three main core principles we want to discuss around this. That's sticking to a disciplined asset allocation, keeping diversified within that asset allocation, and having a well-structured rebalancing program in place ahead of time. That's important so we don't have to make knee-jerk reactions to short-term headlines. The headlines right now, there's a lot of market volatility on a day-to-day basis. But long-term, what drives stock returns is earnings and cash flow. So it's really important to focus on a company's ability to grow their cash flow and earnings over long periods of time and not worry about how last night's headline impacts the price of the stock this morning. Our core three principles are allocate, diversify, and rebalance. Allocation means coming up with an appropriate risk profile based on your long-term goals. This isn't about what's going to happen in the market tomorrow. It's really about your ability to take risk, your willingness to take risk over the long-term future. The second core principle is diversification. Once we determine an appropriate allocation, which is the percentage of stocks versus bonds, it's really important to diversify within each of those categories. So for stocks, you want to own value stocks, you want to own growth stocks, but it's also important to own mid-cap, small cap. We hear a lot in the news about the Mag 7, but a lot of the companies and their supply chains live in the mid-cap space. Those companies benefit by the growth of the Mag 7, but their prices aren't as overvalued and they're not trading at the high multiples the Mag 7 are. And we also want to have a good global diversification. A lot of the big companies that we do business with here in the United States, they're not domiciled here. They're domiciled in other parts of the world, but we do business with them every day. So it's really important to diversify across geographies as well, and also get some good small cap exposure. Coming out of a high interest rate cycle, if we go into a lower interest rate environment, small cap companies could do really well. They're very interest rate sensitive. And if we do have a changing regulatory environment, it's a lot easier to adjust if you're running a small company as opposed to a mega cap company. On the bond portfolio side, we want to diversify as well. It's important to spread that credit risk out along lots of different credits. A great way to do that in the corporate space is to use a good diversified bond fund. So that way you're not taking too much company risk with any one specific company. We also think about duration. Duration is essentially how long it takes to make your money back when you do invest in a bond fund. And instead of trying to predict short-term market rates, a great way to manage duration is to ladder your maturities so you constantly have bonds coming due. Yeah. So our third principle is having a disciplined rebalancing strategy. And this is a very important principle. It's really easy when markets are moving around us and there's a lot of volatility to make emotional decisions. But we know over time that markets generally go up, and we know over time companies that grow their earnings and cash flow will outperform companies that don't. So when we do have a lot of moving pieces, what a disciplined rebalancing program does is it gives us a rule-based approach to how we're going to rebalance portfolios. So after we have a period of outperformance, whether it be for equities versus bonds, or even if it's growth stocks versus value stocks, we have parameters in place that will trigger us to go in, rebalance those portfolios, and bring them back to their target weight. That way, it's forcing you to trim your outperformers, and it's also forcing you to buy into other high-quality companies that might be a little bit out of favor today. By having that process in place, it takes the emotion out of it. Oftentimes, buying into a company when it's cheap is emotionally a difficult thing to do because there's a lot of negative news around it while it's cheap. But time has shown us that it is a great way long-term to add positive return to a portfolio. So in summary, we recommend clients focus on fundamentals. Despite political shifts and economic uncertainties, the core principles of investing remain unchanged. Stick to a well-structured asset allocation plan, diversify across regions and sectors, rebalance strategically, and avoid reactionary decisions.